So, ladies and gentlemen, esteemed guests and senior executives, a very warm welcome to our fireside chat that is happening on maximizing tax savings with insurance and investment options for senior executives. So, this is, I believe, a very innovative and a very different kind of topic that we are covering today. So, for this topic, we have the privilege of gaining insights from Mr. Vivek Jain. He's the head investments at policybazaar.com. Vivek brings a wealth of knowledge and expertise in finance and investments, particularly in optimizing tax savings through insurance and investment options. Please join me in welcoming Mr. Vivek.
Thank you, Mr. Amit. Thank you so much for having me on chat show.
Sure. So, Vivek, just to kick things off, how the investment patterns and preferences evolving in the recent years? If we talk about last 2 or maybe 4 or 5 years, so what are the changes that we have seen in the kind of investment patterns, the kind of customer preferences in terms of their investments, and what are the factors that you attribute to these changes? And moreover, how should senior executives, CXOs, adapt their investment strategies to align with these evolving trends and preferences?
Sure. So I'll answer this question in 2 parts. I think the first part, if I talk about how the whole investment scenario is changing, I think post-COVID, there have been 2 sides of changes that have happened, right? There was one way where the interest rates were going up, right? So there was a lot of movement towards guaranteed return plans, right? Where people were getting 7.5% returns tax-free. And they were able to, and for somebody who was a senior executive or a CXO, 7% tax-free returns in tax adjusted means if you are in a 35%, 36% tax bracket would mean actually 10.5%, 11% pre-tax, right? So those actually investment options were becoming very popular. I think in the last 1 year, if I talk about it, given the Indian equity markets have done very well, I think the market is slowly shifting more towards market-linked plans because the India growth story, which I think we have been talking about for the last, I think almost 5 to 10 years, is really playing out actually better than what most people across the globe had anticipated, right? So given the Indian stock market is doing very well, I think the focus is slowly moving towards equity-linked plans. But given these are HNI customers, see, wealth preservation is always a key important, is a very important parameter for them, right? That is why I think in the HNI clientele or senior people in the organization, I think guaranteed return plans are still, debt-based instruments are still popular, but there is some movement towards equity-linked plans.
So now about the second part of the question. So how do you think that the senior executives should adopt their investment strategies to align with these evolving trends and preferences?
See, I think for senior executives, I think wealth preservation is a big part of why they want to invest rather than wealth creation. Like for a general mass market, I think wealth creation is why people invest. But I think for senior people, it is more about wealth preservation and basically kind of guaranteeing something for their retirement, even when they add, so that they can maintain their lifestyle, even when they are not earning, right? So I think one trend that I have seen, Amit, here is that people are still sticking out towards guaranteed return plans. And when I say guaranteed return plans, there is something called an annuity plan, which insurance companies offers, wherein you pay for a few years and after that you get a guaranteed income lifetime, right? Wherein the interest rate, you're in a way locking in the interest rate today. And this is something that is not available in any other financial asset class, that you can supposing you are somebody who's at a age of 40, you say invest for 10 years, and after say 55, because now people want to retire earlier than not at 60, maybe at 55. So if you want to start your pension from 55, from 55, you will get a pension until you are alive, which with Indian average age of India improving every 5 to 10 years. So I think, like, if you live till 80, 85 for about 30, 35 years, you will get a regular pension, right? In a way, you are locking in the interest rate for the next 40, 45 years. There is no financial instrument where you can lock in interest rates for such a long time. So this is one very interesting thing that is really playing out well in the industry, and people are really getting attracted towards. And again, this is more a HNI segment thing, right? Because you obviously have to invest a decent corpus in the first 10 years, but at that time you're earning, so you can basically invest that kind of money.
Very good. Very good. So, can you also provide an overview of the various insurance and investment options available for maximizing tax savings? How exactly can senior CXOs and industry leaders leverage those options effectively?
See, I would break it into two parts, right? One is, if you are investing in a guaranteed return plan by insurance company, and if the annual premium is up to 5 lakh rupees, right? The maturity of these plans is completely tax free. Okay. So in a way, and these plans still give, like, we have a plan which will still give 7.5%, almost 7.5% return, tax free. So in a way, these plans are where, and there is no other debt instrument now where even if you are investing 1 lakh, 2 lakhs, 3 lakhs, you will have to pay taxes, right? This guaranteed return plan, you can get up to say around 7% return, and it will be completely tax free. So this is about 5 lakh rupees in a guaranteed portfolio.
Yeah.
If you are investing in market linked unit plans offered by insurance companies up to 2.5 lakh rupees annually, then also there is no LTCG tax that you have to pay. So if you are investing up to 7.5 lakh rupees annually, 5 lakhs in a guaranteed instrument and 2.5 lakhs in a market linked instrument, the maturity is completely tax free if you invest through insurance companies. Beyond that, earlier the limit of this 5 lakh was not there. So actually, people used to invest a large sum of money in guaranteed return plans. Now that limit has been, in the last budget, has moved to 5 lakhs. So up to 7.5 lakhs, if you are investing, you will get tax-free maturity.
Very good. So, when we consider tax-saving investments, how do you recommend senior executives strike a balance between risk and returns? So, especially considering their unique financial goals and their kind of risk appetite. So, what is the recommendation that you would have?
See, there again, it depends on your age and your goal, right? If somebody is young and who has basically climbed the corporate ladder early, right, they can take certain amount of risk and invest in equities. By equities, I mean market linked plans, right? But if you are above 40, right, or 45, your risk appetite kind of decreases. And if you are, say, investing for something for your retirement, you want a certain amount of surety. Yep. Then debt instruments or guaranteed return instruments are better. So it actually depends on the life stage and the goal that you are investing for. That is how you should manage the risk and return.
Okay. So in addition to insurance, what are some investment vehicles or financial instruments that senior executives can explore to maximize their tax savings and get better returns? And how can they align these investments with their long-term financial objectives?
So I think two I'll basically two parts to it. One I think if your company offers corporate NPS, okay, under section 80 CCD2, up to 10% of your basic salary, and there is a limit of 7.5 lakhs annually, you can invest in NPS, and the amount that you invest will be tax free. And at the time of maturity, which typically is at 60 or when you retire, 60% of the money that is there you can withdraw it tax free, and the 40% you have to mandatorily buy an annuity at that time.
Okay.
So this is a very, very good option. Why? Because 10% of your basic salary is getting invested for your retirement. So your retirement goal is getting secured. Plus, you are not paying tax on that 10% of the base salary. So you are saving tax at the time of investment also. This is a less popularly known tax saving instrument, but this again has to be done only through a corporate NPS. The retail NPS has a limit of only 50,000 rupees annually.
Okay.
Yeah.
So if we think about the immediate tax benefits, how can senior executives ensure their insurance and investment decision contribute to a long-term wealth preservation and financial security of themselves and their families?
See, I think for senior executives, first thing that they should definitely have to ensure that their family is secured is buy a term insurance plan, right? And buy a term insurance plans, which is a sizable amount, maybe at least 5 crores, if not 10 crores. Right? Yes, you will have to maybe undergo medicals, but I think it is always good to have a term insurance plan so that in case something happens to the senior person, the family's lifestyle doesn't change a lot. The other very interesting thing for insurance is there is a concept or a feature called waiver of premium plans. What does a waiver of premium plan mean? If you are investing in, say, a market-linked plan for a specific goal that you want to send your child to, say, Harvard or Stanford, when he or she goes out for graduation or post-graduation, right? There will be a spend of about maybe 3 to 5 crores. If I bake in the education inflation, after 10-15 years, that cost will be somewhere between 3 to 5 crores, right?
Yeah.
If you buy a plan with a waiver of premium, in case anything happens to you, the future premiums will be paid by the insurance company. Okay. Which again is not a very, very unique feature because it is not available in any other in any other asset class, right? If you are investing through, say, a mutual fund, whatever money you would have invested till the time you were alive, that is what will build the corpus. In this case, the insurance company will pay the remaining premium and the goal for which you are saving will always be secured. So I think the waiver of premium and yes, term insurance is the first thing that they should have, a sizable term insurance. But for non-negotiable goals like child's education, child's marriage, even spouse's retirement, you can look at buying a market-linked plan with a waiver of premium.
Okay. So senior executive in the range of maybe between 40 to 50 years, 40 to 45 years of age. So what would be your suggestion for a portfolio, for an investment portfolio for a person, okay, who has bought a small family, who is in the range of, who is about 40 to 45 years old and a senior executive, well placed. Okay. So what would be your suggestion? What would be your recommendation for a investment portfolio for that kind of person?
See, I think very important to plan retirement for somebody who is in that 40 to 45 age, because I think he or she only has maybe 10, 15, 20 years of service left, right? Yep. Then the first goal that comes to my mind is, I think, planning the retirement for yourself and for your spouse. I think that is one very, very important thing. So our annuity plan there can be really helpful because there you are locking in interest rate for your lifetime. And there are joint life plans available where you get the pension till you are alive, and then the spouse can get the pension till he or she is alive. So there are joint life options available there. I think the other goal would be that child's education and child's future should be secured. So a plan with maybe a waiver of premium to secure that goal is also another very, very important thing. Because I at 40, 45, if somebody is doing well and plays well in his or her career, I think the basic needs of having a house and a good car, all of that, I think would already be taken care of is what I am assuming. Right. But I think these important life goals, which are kind of non-negotiable, they are very, very important to plan for.
So, one more thing. Do you think that a person who is so senior, who knows, who has been investing a lot, okay, so is it required to have, is it very much crucial for that person to have a personal investment advisor to manage the portfolio, to basically to ensure that the portfolio grows and there are uh, adequate returns coming in? Okay, so do you think that the personal investment advisor is so much required?
I think it's a personal choice. Amit. I think there, some people really like to manage their own money. And even in their busy schedule, they are able to find time to manage their money. And some people would prefer that, no, I will focus on maybe my job or my business, but let somebody else grow my money for me. Right. So I think it's again, the person has to decide for himself or herself that do they like managing their money, or do they think that this is a very big hassle? Because see, a lot of people in financial services may have a lot of understanding and depth of how the financial markets work. So they may want to manage their money themselves and say that if somebody else will manage my money, maybe they will get a suboptimal result. Right. So it's a very, very personal choice. But I think, yeah, people who will not have a lot of time, they maybe can look at having a personal boutique manager or fund manager, if I may call him.
Very, very. So, coming to the last question. So, looking at the current economic landscape and geopolitical factors, what is your outlook for the investment market in the near to medium term? And what would be your advice for the senior executives navigating the potential market volatility and uncertainty in their investment decisions?
See, very frankly, nobody can predict the capital markets in a short term. But I think from a medium to long term perspective, the India growth story is really playing out very strongly. And that is something that I think globally everybody is realizing and taking notice of. Right? A strong central government is also helping basically drive a lot of initiatives that were planned in the last decade. A lot of investment on infrastructure, manufacturing, Make in India, all of that is helping India really grow and do well. So I think, see, the long-term India growth story still remains very, very strong. So medium to long-term, I personally am very, very bullish on the Indian capital markets. Short-term, I would say nobody can kind of predict in 6 months or in 1 year what will happen. That is very, very hard to predict. But I think very strong India growth story. So I think 3 to 5 years view for India and Indian capital markets is looking very, very strong.
Very good. Thanks a lot, Mr. Vivek, for sharing
Thank you, Amit.
valuable insights and valuable expertise on maximizing tax savings through insurance and investment options for senior executives. Your insights have been enlightening and invaluable, personally for me as well.
Thank you.
So, and to our audience, thank you for joining us today. We hope this fireside chat has provided actionable strategies, insights for optimizing financial planning and tax savings. Have a great
Thank you, Amit. Thank you, Mr. Amit. Thank you so much.
For more updates from CXO TV, please like and subscribe to our channel.